On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, we're going to take a look ahead to 2025 today and talk about some of the things that I think might happen over the next 12 months. Financial markets are notoriously difficult to predict, especially over short time frames, and certainly 12 months is what we would describe as extremely short in investing terms. Now, I don't have a lot of faith in forecasts, predictions, or price targets, so it is a little bit hypocritical of me to be offering them. However, I have equally little time for analysts or strategists that sit firmly on the fence and are too afraid to go out on a limb and take a view. So I'm happy to have a go, even though I know full well that I will be wrong, and it will just be the degree of wrong that is hard to predict. Trying to come up with a few market predictions as well does focus the mind. So here are my 6 predictions for 2025. Number 1, the New Zealand economy drags itself out of recession more quickly than expected. We've been in recession for 2 years now on a per capita basis. That means per household, per person. So if it has felt difficult, then that's because it has been, absolutely. But there's also light at the end of the tunnel. Fresh GDP, that stands for gross domestic product, and that's how we measure economic growth. Fresh GDP figures are out this week, and they will look better than we've seen for some time. But I think it will be early next year when things really pick up. And I don't think we'll have to wait quite as long as usual for those lower interest rates to drag us up a little bit. Borrowers over the last 12 months or so have all opted for shorter mortgage terms. People have been floating or going on the 6-month rate or the 1-year rate rather than those typical 2 or 3 year rates that a lot of Kiwis have opted for in the past. What that means is that we won't necessarily see that same lag as we wait for those lower interest rates ease the pressure on household budgets. We're also headed for the highest ever dairy payout this season. Fonterra's got a midpoint of $10 in its forecast range. That will boost activity across many agricultural regions, while we're also seeing business confidence point to better times ahead. So I'm watching out for a marked change in tone during that February reporting season as companies start to see evidence building of an improving backdrop, and that makes for much better outlook commentaries. Number 2, interest rates fall further, but not quite as much as some are hoping. We've seen 2 50 basis point cuts in a row to the official cash rate, and I think we'll get a third in February, so that'll be 3 in a row. We also had that 25 basis point cut to kick things off. So at the February meeting, we'll likely see the policy rate fall to 3.75%. That's below that 5.5% peak we saw this cycle from earlier in the year, and at that point, the Reserve Bank will revert to smaller moves. It will start to move in 25 basis point increments. That will be very good for borrowers, consumers, and the economy overall. However, most of the fall in mortgage rates is probably behind us, and those popular 1 or 2 year rates will likely remain in the 5s or thereabouts. I don't think you'll see the OCR fall back quite as much as we saw it fall to during the COVID period, or even in that pre-COVID period. Between 2016 and 2019, it was sort of sub 2% for a lot of that time. I don't think it'll go that low. I think it'll fall to about 3, maybe even a little higher than that. So this period that we're coming into, 2025 and 2026, that will look more like the 2014-2015 period in terms of where mortgage rates go to. So you can't look back to 2017, 18, 19 before COVID and look at what rates were doing then. It might not necessarily marry up, but you will see falls. Just don't get your hopes up about them being really dramatic falls. Related to this, I think the housing market will recover, but it won't boom. Now, for the last 2 years, house prices have been pretty flat. They've done very little, and they're still more than 15% below their peak, which came in late 2021. Now, lower interest rates and improving demand and a stronger economy, household budgets that look a little bit better as interest rates are lower, that should ensure that values rise in 2025. However, don't get too excited. Homeowners shouldn't be expecting another major boom where you see double-digit increases. Like I said earlier, the OCR isn't likely to fall to as low as it was in that 2016 to 2019 period, and also affordability is very low. Even though you've seen prices fall 15% from their 2021 peak, remember that they rocketed it up in the year or two before that peak. They rose almost 50% in the 2 years leading up to it. So right here and now, prices are still 25% above where they were just as we went into COVID at the start of 2020. Since 1990, house prices have increased by an average of 5.9% per annum. So that's kind of the norm, that's the average, and I think homeowners should expect something closer to that next year, something in that 5 to 7% growth range. Don't expect things to be much more buoyant. Right, prediction number 4, the New Zealand share market. I think it's set for further solid gains, and I'm quite optimistic about its prospects for 2025. The NZX 50 index is up about 9% so far this year. That's very close to the long-term average, and it will be the best return that we've seen in 4 years. I think there's more to come next year as the economy recovers, as corporate earnings grow, dividends grow, and as investor sentiment improves. The local market is offering a gross dividend yield of about 4.5% at the moment, looking ahead to 2025, and there's a good chance that investors enjoy a double-digit return in terms of that dividend, plus what you get in terms of capital gains and share price growth. So things do look solid as we look ahead to 2025 for the local share market. Number 5, the currency. I think it could remain soft against a buoyant greenback US dollar. At the moment, the Kiwi is trading at about US 58 cents, so that's more than 10% below its 30-year average of US 66 cents. Most economists from the big banks see it back in the 60s by the end of 2025, so they expect it to rise, but I wouldn't be surprised if it remains weak, at least for a good portion of 2025. The US economy still looks much stronger than most. The US Federal Reserve, the central bank over there, is likely to tread more carefully, go a bit slower with its interest rate cuts because the economy is much stronger than we're seeing in other parts of the world, including here in New Zealand, and that means that you could see that interest rate differential widen. So US interest rates will remain higher than New Zealand interest rates because our Reserve Bank is cutting more aggressively. And that should ensure that the greenback remains well supported. And when you throw in some of those policies that are designed to put America first from the Trump administration, that could mean that America wins at the expense of other parts of the world, notably China, which is New Zealand's biggest export market, remember. Put all that together and you've got a recipe for sustained weakness in the Kiwi. Now, that's not the end of the world. A lower currency means that our export sector gets a boost and it's good for economic activity. However, the other side of the coin is that it means things cost more for us to buy, so imported goods are more expensive. That potentially puts a bit of upward pressure on some of those imported inflationary products, and it also means if you've got an overseas holiday planned, particularly to the US, things aren't really going to be in your favour. So very much wins and losses when you've got a currency that's a little on the soft side. Last one, and this is perhaps the toughest call of all to make, US shares. I think they'll be more volatile, but I do think they'll ultimately have another up year. So we'll expect to see more ups and downs than we've seen this year and last year, but I think US shares will have another positive year in 2025. While New Zealand shares remain 15% below their 2021 highs, we've seen most major indices around the world hit new records. So in the US, and the UK, in Europe and Australia, all of those share markets have hit new highs during 2024. The US has very much led the charge. The S&P 500 is up 28% this year, and that comes on the back of a 24% gain in 2023. So it's been a cracking run. And on some measures, it does look highly priced after such a good performance over those 2 years. But that doesn't mean we won't see another solid performance next year too. analysts are expecting earnings growth of 15% next year for the S&P 500 in aggregate. Now, analysts do tend to go into each new year a little bit enthusiastic, sometimes too enthusiastic. So even if you shave a little bit off that for their typical optimism, let's say it's 10 or 12 rather than 15%, you've still got a fairly healthy improvement in corporate earnings. And over the long term, corporate earnings is ultimately what drives share prices. The backdrop also looks quite friendly. Inflation has been largely tamed. Interest rates are headed lower, even if the Fed goes a little more slowly than our Reserve Bank does. And the incoming administration will take a pro-growth, business-friendly approach where they try and look to remove regulation. All of those things are a pretty good recipe for share prices to continue delivering. Don't expect a third consecutive 20% plus year. I don't think you'll get that. But if a recession has indeed been avoided, and many of us think that it has, then the market will be up again in 2025. However, we should definitely expect many more ups and downs. I think it will definitely be a more volatile year than we've seen in 2024 and 2023. Investors will be grappling with the threat of tariffs and what that means, so we should expect more volatility across global share markets, including the United States. We also need to keep an eye on some of those sectors that have lagged the high flyers. Some of those sectors outside technology, outside AI, they might do a little more of the heavy lifting in 2025. So those are my 6 predictions. Good luck with your investing. Remember to talk to your advisor before you make any moves, and please do send me feedback. Always happy to look at other points of view and debate what we're seeing out there across markets. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.